Next up is a conversation on tokenization. It's called Why Tokenize Anything, Efficiency, Liquidity, and New Financial Rails. Moderating the panel will be Kyle DaCruz, who is a director in the Digital Assets Product Division at VanEck. Go for it.
Great. Thank you so much. Great to be here. It's not lost on me the irony that we're talking about the future digitization, tokenization, and my notes are on a piece of paper, so we'll go with that. I think at VanEck we try to work smarter, not harder, so I do think I'll follow Brett's lead and have us all introduce ourselves. So maybe just a quick minute, your names, sort of what your firms are doing. I think everyone is pretty familiar with all these firms, but maybe specifically in tokenization, what your firm is doing.
So hello everyone, I'm James Lang with Liberty City Ventures. We are a venture capital fund that focuses on equity investments in blockchain technology companies. So we're helping companies build the infrastructure for this new exciting world. And we're looking at the companies that are providing those building blocks and infrastructure for tokenization.
Yeah, I'm Chris Zuehlke with Cumberland DRW. Cumberland is the digital asset arm of DRW, which is a global proprietary trading organization. We are involved in tokenization world in a few places. We're big liquidity providers. We also have embarked on building several different things in the tokenization space, as well as trying to be at the forefront of adopting some of these use cases. Things like tokenization of treasuries for repo and financing, collateral mobility, those sorts of things.
All right. Did I do this the right way? No. Okay. Hi, my name is Cynthia Bessette, and I run the Digital Asset Management Division at Fidelity. Fidelity has been in this ecosystem looking across cryptocurrencies and now tokenization for probably over a decade now, and launched our crypto custody business back in 2018, and a couple of ETPs in the last year and a half. We are also actively pursuing looking at bringing more assets on-chain. As an asset manager, there are a number of drivers for why it is that we think this is really important. We did file for, and this is public, to bring a money market fund on-chain. It's not just simply because we think that our brokerage customers want to buy tokens, but rather we think there's a broader thesis about an integration between traditional markets and on-chain markets, and it's about the flow of capital. And so an area on tokenization that we think is really very interesting is making capital available across both traditional markets and on-chain markets.
Hello. Hi, all. Kathleen, Wrynn, Global Head of Digital Assets at Invesco. It's a very exciting time right now in Invesco. We just recently launched a global product organization several months ago. I joined about 6 weeks ago to really build out our digital assets team and strategy. We have been, though, in the blockchain space since 2019. We launched our first product, and now we're actively looking to grow out our product suite across crypto-linked products as well as tokenized funds.
And I'm Caitlin Long, CEO of Custodia Bank. We own the seminal patent on tokenizing a US dollar that we applied for in 2020. That's going to become a hot topic as this all gets rolled out. We have a partnership with Vantage Bank, and we're doing both tokenized bank deposits with banks as well as stablecoins ourselves as a permitted payment stablecoin issuer. We're one of the handful of companies that already has that designation.
Excellent. So maybe before we go from tokenization, what it is today, to where it's going to go in a future state, maybe we start with sort of, and I have air quotes here on the harsh reality of the state of tokenization today. It may not be as harsh as some think, perhaps it's harsher than others think, but maybe we could start with you, Caitlin, sort of on the tokenized deposits versus stablecoin side and sort of that narrative, and maybe a lot of folks don't understand the nuances between those two.
Yeah, it's the same technology, but a big difference in the regulatory backing and the backing of the assets. And to be honest, I really haven't seen very much of a distinction of that topic. Everyone is obviously focused on the Genius Act, but very few have talked about the fact that the Genius Act carves out bank deposits. So Genius Act only covers stablecoins that are issued by permitted payment stablecoin issuers, which are non-banks. So the really big question is the banks, right? The banks originate 1.1 quadrillion of Fedwire payments, about 88 billion of ACH payments. By the way, the two biggest banks, JP Morgan and Wells Fargo, between the two of them originate more than half of ACH payments. That's not very well understood. So what is going to happen with tokenized deposits when you look at that volume? When you say, you look at 3.7 trillion, which is Citi's forecast of stablecoins by 2030, I'm not sure exactly how they're defining stablecoin, because a lot of people think, well, a tokenized bank deposit is a stablecoin. It's different. But when you look at 3.7 trillion and you compare it to those incredible payment volumes, it's just a drop in the bucket. And I've always believed, which is why we applied for a bank charter in 2020 and got that patent granted to us in 2022, that the entire market was going to go bank. Because you have to be able to get direct connectivity into the Fed. We took on the hardest problem in that, which is the direct connectivity to the Fed, and it's the last regulator that has not relented yet.
And maybe from the asset manager side for Cynthia and Kathleen, so both of you have global asset managers that distribute globally. And kind of piggybacking off Caitlin's sort of lack of regulatory clarity, maybe intentional, maybe not in some bills. But do you feel that the lack of regulatory clarity today is still significant enough that it's sort of slowing down the distribution plans of tokenization today? Is there more needed, or do you feel there's enough to sort of work in multiple jurisdictions?
I'll start by saying the lack of regulatory clarity has a couple of major implications for this market taking off. The first of which is the lack of market clarity deters infrastructure providers and deters regulated institutions from participating, which then eliminates a very significant segment of the population from being able to use services that are powered by blockchain-based rails. The second part of it is, as there are projects that continue to bring assets on chain, clients are also deterred from participating if there isn't regulatory clarity for what it means to get access to the instrument. And without infrastructure, how is a client going to be comfortable with how is it that asset fits within their portfolios? And maybe the other thing I would say about tokenization, we think it's important, but not important from the standpoint of clients are calling us asking us to buy tokens. Nobody's calling us to buy tokens. From the standpoint of a client's perspective, they're always interested in getting better access to financial solutions. They care about what the performance of the portfolio is, and they care about access to instruments that will help them to better manage their financial lives. And none of them are asking for how is it that they can open up a wallet and hold tokens in their wallet.
And I think on that front, just to add to that, that's why it's really, I think, critical to do both building out further crypto-linked products and traditional vehicles at the same time as looking to build out tokenized funds. Because right now there is growing interest from institutional investors on these crypto spot ETPs and then a variety of other vehicles. But when it comes to actually tokenized funds, we are seeing a lot of investment, especially from the Web3 community. But in terms of traditional investors, it's going to take time before they want to manage the on-chain friction that comes with owning a wallet, things like that.
Yeah, I mean, I would agree. At VanEck, obviously, we have some crypto ETPs, and it's not just limiting your infrastructure in the building, but also investors being comfortable with investing in the space, right? And sometimes just a little bit of change or narrative change will allow some of these larger institutions, I'm sure you're dealing with the same, that the calls and the questions began as soon as the government and the SEC and other organizations sort of gave the general cautious approval.
And maybe just on the narrative front, doing digital assets 4 or 5 years ago in asset management, it was all why blockchain. Now the last 6 weeks, after stepping back into asset management, it's all how, when, let's get more involved. So it's really amazing how much the narrative has changed.
Yeah, I think there's definitely a lot of enthusiasm around now there's more engagement from a regulatory standpoint. There's clarity being given to infrastructure providers being able to provide services. And now it's really a matter of how and where to start with your priorities.
So I'm turning over to you, Chris, maybe, and happy to jump in on the regulatory, but diving a little bit deeper in the harsh reality of today. What is being done wrong that we need to improve as an industry, as different methodologies? There's sort of the wrapper style versus the direct issuance in a private fund. There's a lack of standardization of investor flow. There's sort of concentrated demand in a lot of these large funds from the same buyers. And as issuers, you're starting to try to find what the TAM is today, and it's quite small. So what do you see as some of the biggest challenges today in tokenization?
I think I would start by just at least acknowledging its success or two, right? The most successful, at least I think the most successful tokenized asset is the US dollar at this point. There's what, like 250 billion worth of USD-backed stablecoins. And with the recent passed legislation, I think that's only going to increase. But most notably, now that these organizations are going to be federally regulated, they're probably just a step or two away. You know, Caitlin might disagree with how long that step is, but step or two away from getting access to deposits with the Fed. And at that point, you now have a stablecoin issuer that potentially no longer has the exposure to fractionalized banking risk that I would have with my dollar deposits at another bank. And we're now in a world where you need to talk about the implications of that from like a debt issuance perspective as more of the treasuries kind of get pushed to the front of the curve. But you're in a world where you have a better dollar than the dollar for at least like settlement purposes. And like, that's a fascinating thing. I don't think we should really ignore the wins and the successes on that side of the industry. Now that said, I do think there are things that need to continue to improve. You mentioned this concept of like a wrapped versus a kind of a native issuance. I do think that is an important step for the industry to take. I'm sure there'll be product market fit for some of these kind of broker-dealer wrapped securities that are being issued out there. And you know, whether or not that is sufficient for the long term or not remains to be seen. But I do think a world in which you have the CSDs themselves natively issuing the securities on chain, like that seems to be a very important step to remove some of the counterparty risk that would take place there. I also do think you need to start to find kind of additional utility for these assets. It's one thing to say, hey, we've tokenized, I don't know, whatever, I don't know, soybeans. But what are you going to do with tokenized soybeans? Now, I understand there's a use case there, and I'm not an expert in the logistics of the supply chain, but it seems really, really complicated. Now, you look at the tokenization of other assets, say just treasuries, for instance. Well, there's immediate utility there because you could post those for collateral, potentially in near real time, 24/7, or to facilitate repo. And so I think that's kind of where we're focused now, is less about like what's bad with it and more about we have something that's truly unique and interesting. How do we apply it for a purpose that has something beyond just the headline of it's been tokenized?
So we know that Bitcoiners wouldn't buy your seed oil token, but James, maybe we could talk about if there was a different way to tokenize and maybe more similar to an ADR or ownership actually on chain. Maybe we could dive into that a little bit.
So what we'll look at as the ultimate state is when the ownership ledger is actually on a blockchain, and you're seeing movement towards that. You see in one of the holy grails of tokenization has been real estate. I've been in this space since 2012. Everybody's tried to tokenize real estate. It's very complex because you have a whole bunch of real world things that you need to deal with. Title registration, mortgages, filing liens. And when that ownership ledger exists on a blockchain and you can have that same functionality on a blockchain, that's really what's going to unlock the value in the tokenization of real estate. And what's also underappreciated is the standardization that tokenization brings to financial services. I used to work at a bank in the back office. They had maybe 5 or 6 different clearing departments, one clearing department for every asset. That's going to converge. There's going to be one department that clears tokenized assets. It's going to be huge cost savings for our financial institutions. And that's also going to lead to what I would call sort of an industrial problem, which is we're going to look at the utilization rates of our collateral and how that's deployed. So we're going to have to, from a financial system, get that driven closer to 100% because there's a lot of inactive collateral most hours of the day.
So maybe you just hit on a really interesting point is having a central ledger where all of the assets are able to be represented. You're now going to see an opportunity for more cross-market swaps and exchanges, because today everything goes back to cash, right? If I want to sell my Apple stock and I want to buy NVIDIA, I've got to sell Apple stock for cash, right? There isn't a direct swap. From a mathematical standpoint, we can come up with a price equivalence, but we all have to come back to that extra leg of the transaction. So more inefficiencies can be taken out with creating more of that standardization.
So actually, that's a great segue to, and maybe we'll start with you, Cynthia, but the traditional players today, this is a pretty institutional panel. But generally, did the institutions today have sort of the technical capability and infrastructure to sort of connect the old legacy systems to the new? Does it require a new build out? Does it require a partnership with some more native crypto firms? Well, what's your view generally, not specifically from Fidelity's standpoint?
So I think from an overall general standpoint, and we just actually talked a little bit about the difference between traditional markets, which I think probably I speak for most everybody from a traditional institutional standpoint, is our systems were designed for a market close. And that market close happens right at the end of the trading day and allows for all of our systems to catch up to all of the transactions that happen throughout the day. The globalization of markets has challenged that a little bit, and so we've created some manual workarounds to be able to allow for that activity. But the blockchain is never off. Blockchain is constantly able to reflect transaction activity, and so having a native or an asset that has the ability to be transferred multiple times during the day, but yet not having a record-keeping system that's able to keep up to it is going to be a challenge, and it is a challenge, and it is something that, from the standpoint of issuers looking to bring assets on chain, we've talked a lot about representing the asset on chain. It's a traditionally issued asset. That traditionally issued asset is still tied to a central ledger that still only gets updated once a day.
And it's analog too.
Monday through Friday, and not on holidays.
So just to chime in there a little bit, so we've operated a 24/7 business for, I don't know, 10 plus years at this point. And so I get into this conversation a lot. What does it take to actually upgrade your systems and operations to 24/7? And
so follow the sun.
Right? Yeah, the follow the sun model. And listen, we're biased. We've kind of built the business, so I'm not going to pretend like it's easy. And oftentimes I'm met with this, well, we don't work 24/7. How do we go from here to there? Yeah. And my immediate reaction is I don't believe you when you say you don't work 24/7, because during a major market implosion, do you think the CROs and the head traders, they're not putting their phones down and going and watching a football game, right? They're glued to the screens, and they're just waiting and hoping that when the market opens on Monday, people make their margin calls, that the markets won't go limit up or limit down right away and close on volatility pauses. They're without the tools to manage their risks on the weekends. And so I think if you were to tear it all down and build it back up from scratch, nobody would have suggested let's close for 48 hours during the week. Nobody. It makes no sense.
100% agree with that.
And so it's a very difficult problem to solve. I recognize that.
Yes.
But it's a use case driven solution now. Because if I'm able to imagine a world in which you could avoid the gilt crisis because people are able to mobilize collateral and immediately pledge it rather than have to further sell gilts and drive the price down. What would have happened? I don't know how quickly the problem would have been short-circuited, but it probably would have stopped much quicker. And so I think what's happening now is people are identifying with blockchain and tokenization that there is a true utility to subsidize risk management in the system and increase determinism in the system, which is a critical function. And so, maybe you can't convince traditional institutional providers or service providers to, say, offer spot crypto to their customers or whatnot. But if you go to the heads of the risk department and say, by the way, we could take your risk of default for counterparty risk down by 80%, now they're listening.
Yeah.
I made that 80% number up. I don't know if it's true, but it's non-zero.
But you can add to that, right, which is also going to resonate with institutions, is the cost of capital, right? Because the collateralization doesn't come for free. And so immobilizing capital for collateralization purposes, and then waiting for the sweat beads, right, for Monday morning when the market's open, you're like, okay, what do I need in liquidity in order to meet my margin calls?
Yeah, and so for us, and you saw people arguing about privacy on chain, and we believe that Canton is a great solution for this stuff. But privacy is becoming a thing that people are most concerned about. Not 24/7, but how do I make sure people don't see me moving my variation margin around? Yeah. How do people how do I prevent people from seeing what my inventory is in my wallets? And so, I think that is going to become one of the more critical components to all this. Is how do we solve for privacy?
Kathleen, did you want to add?
Yeah, I think it's also not going to be a one size fits all case. I think that also for each institution, it's really what are your skill set, what do you do best, and partnering where possible, especially with digitally native firms, to help bring that infrastructure in house as well. I think is really important.
Maybe Kaylin, really quickly, just because I saw you nodding your head quite a bit, but maybe from the banking perspective, can you add a little bit?
Yeah. two thoughts. One is every tokenized trade ultimately has to go through a tokenized dollar somehow. Okay, so now we're back to this same problem of if the banks aren't ready for tokenized dollars, then the market is inherently going to be smaller. And we have not yet heard from the bank regulators, the most important of which is the Fed, which, let's face it, obviously our situation with the Fed is very public. The Fed ran out all of the people who were knowledgeable in this area under Michael Barr because he wanted to quash it. He was part of Operation Choke Point 2.0, worked with Gensler and Marty Grunberg at the FDIC, and they wanted to try to kill it. So now they actually are scrambling. I can tell you this because of friends that they are recruiting. They are scrambling to try to get people in who know something about it. And so I think it's going to be interesting because the Fed hasn't come out and said yet what the risk weighting for stablecoins is going to be. And that's a really, really important question that we all need to know the answer to. Is it the same as an FDIC insured deposit at 20%? The moment that comes out, I think we start to actually see tokenization take off because you get the dollar piece of it solved. Switching gears real quick to the securities piece, I was part of the Delaware Blockchain Initiative. Anybody remember that? 10 years ago, we were trying to get Delaware to register corporations natively on chain. And 10 years later, we're still trying to do it. And part of the reason I went back to my native Wyoming is because Wyoming's the #2 state behind Delaware for corporate registration, since Wyoming is where LLCs were created. We haven't even been able to succeed at getting the Wyoming Secretary of State to register anything on chain other than DAOs. So this is a really important point because you have the directory problem in the tech and operations parts of financial institutions, which is how do you associate a wallet with an account on your directory? And if the asset is not natively digital, if we could get corporations to be natively digitally registered, it's super easy to do this. But until then, the stock that you're trading is associated with an analog piece of paper that might actually exist in PDF form at the DTC. And that's a hard problem to solve. It's much easier if we can actually get natively digital corporate registrations.
James, did you want to add there maybe on sort of the digital versions of, say, real estate as collateral and other?
Well, I would echo that. We need this underlying blockchain ledger of assets, and we might not see it in securities first. We might see it in other natively digital assets like data. So data might actually be an asset that gets tokenized sooner and more effectively because it's natively digital, and with the programmable money, it's easier to transact instantly. And you can do it on consumption-based. We're looking at this within AI models. So tokenization isn't just securities. It's a whole set of other assets. And this is going to expand the set of collaterals, which also, ultimately should lead to a sounder financial system because you can pledge any asset rather than just a selection of assets that are in your particular account at a particular financial institution as the collateral for your loan or your margin call.
So we talked a little bit, and Chris, you kind of alluded to this, but one of the early use cases in Wins is sort of tokenized dollars, whether that's through stablecoins, tokenized money market funds, which have been pretty successful today. As far as a collateral use case, V2 is sort of the chase for yield in the private funds, particularly private credit funds have sort of been the hot topic lately, and we've gone from tokenized money market funds to private credit. And it sort of feels like, are we just going up the risk curve and higher yield, higher risk, or is there sort of a road, a trajectory of what's the next hot product in tokenization? But Kathleen, Invesco private credit manages $47 billion plus. Maybe we could start with you and your perspective of why is private credit so hot now? Is that driven from demand and the crypto TAM of the buyers, or is that there's something bigger at play here?
Yeah, I think from an asset management perspective, we're really seeing the two kind of edge cases. So on the one hand, we have the tokenized money market funds where every basis point matters. And the other extreme is private credit solutions as well. So I think we're going to see a lot more in that space, especially from a private credit perspective. There's Money Market Plus, which is kind of like a little more risky, but also more yield. We have a distribution agreement for a tokenized senior secured loan strategy in APAC. I think that's a very exciting space. We actually just onboarded a global head of private credit as well. So we're investing very heavily in that space. I think there's going to be a lot of opportunity there going forward.
And I would say after private credit, and you've seen with the announcement of X stocks from Bakkt, from Robinhood tokenization to equities, it sees, at least narrative driven, we're going towards equities, whether that's direct equities, whether that's funds. Comments, Chris, on that, on how long it's going to take for that to be standardized? Do you see pricing differential between primary market and on-chain representations and the challenges associated with that?
Yeah, so I don't want to immediately get something wrong by predicting a timeline on that, but what I will say is, so the pricing differential is an interesting, question. At the end of the day, pricing ebbs and flow as a result of liquidity. So I think there's obviously a liquidity component to how that all takes place, but I mean, even the ETF markets, like the actual traditional ETF markets, there are differentials, right? There's a reason why the creation and redemption mechanism exists, and there's organizations that facilitate that process because at times, depending on supply and demand in the market, you deviate from NAV. We've seen something similar in stablecoins, right? At times, based on supply and demand, you deviate from NAV. And so I think to recognize the fact that there will be pricing differentiation or kind of differentials from the underlying assets, that's kind of just a fact of markets and supply and demand curves. So I'm not too concerned ultimately. I think the market will become extremely efficient over time, similar to the way it has taken place for traditional ETF creation and redemption. What I think is more interesting in the conversation is how to think about what the implications of tokenization on, say, something like the U.S. equity market structure is. For instance, there's Reg NMS, which, if you're not aware of it, it's kind of a sweeping rule on how to address the fact that there are multiple exchanges all trading effectively fungible assets. And one of the rules is this concept that if I'm able to buy for 2s on one exchange and 3s on the other exchange, if I try to buy as 3s, the exchange has to route me to go buy the 2s instead. So always give me the best price. What happens when I have a tokenized security on one exchange that requires a fully funded trading model and I don't have funds on that platform? I try to buy a worse price away and the exchange now tries to route me to the tokenized location where I don't have assets, I don't have the infrastructure necessary to trade it. There's some really, I'll call it interesting if you're a market structure nerd, but really interesting market structure questions on how do you actually think about what needs to change from a regulatory perspective to solve for this new technology. And I think that's probably where the focus needs to be, because effectively, markets and pricing are delineating, and they will evolve towards the efficient frontier. We got to solve those the substrate problems.
So maybe, James, you could add to that. When you're looking at new investments from the infrastructure side, are you looking at it as who has the best mousetrap today from a technology perspective? Is it who's building for a world where regulation allows different infrastructure, or sort of how are you viewing that?
We view it as who's building towards where regulation should evolve. And to Chris's point, obviously you have a best execution guarantee. Regulation needs to adapt to that. Regulation is going to need to adapt to different jurisdictions, because if we have tokenized assets, they're going to be trading 24/7 worldwide in a variety of jurisdictions. And if they are out in the wild, tokens, not within a walled garden, people are going to own those tokens who haven't been KYC'd, who aren't customers of exchanges, and there are a whole set of complexities to allow those markets to develop and to avoid that price disparity that would exist when these markets don't have the ability for people to arbitrage them and collapse the prices towards the same price.
And we each have a few minutes left, but I did want to kind of get into TAM today, total addressable market today, versus what the future is, right? So 26 billion, a lot of that includes sort of tokenized HELOCs, not necessarily just funds and equities. And some estimates showing up to 16 trillion. Is that low? Is that high? Does everything get tokenized? And if so, is that 10 years from now, 20 years? What has to get us from here to there in between all that white space? Maybe we can start with you, Caitlin.
Yeah, Chris made a really interesting point about the infrastructure to be able to go back and forth between the different tokens. That's exactly what we're building with our bank partner, going back and forth to make it fungible between tokenized bank deposits and stablecoins. That's really, really critical. And if we nail this right and we abstract away some of the complexity of being able to do that, and we are running 24/7 operations, then I think the 16 trillion estimate is way low, because again, when you start to look at I gave you the 1.1 quadrillion is Fedwire, the 88 trillion is ACH, and there's about 400 trillion of cross-border payments. So 16 is a drop in the bucket if we do this right.
I would
Yeah.
say, way low, because there are a whole bunch of novel assets that are going to get tokenized that are very easier to tokenize. Things like accounts receivable, and these assets are going to be tokenized and traded, and it's going to really expand the TAM.
Cynthia?
So from the asset manager's point of view, as we construct portfolios, we're always looking for where are we going to get the best price and the most liquidity in bringing that asset into a portfolio. And so I do think that the numbers on the overall TAM for tokenized assets is very low. If you're saying 16, I look at what is the total capital markets market cap right now across all assets, and it's something close to like 40 some when you look at what's in asset manager portfolios. So from that standpoint, the TAM is really about not trying to bring everything on chain, but to make it easier from a investor standpoint to look holistically at what their portfolio is, and to be able to have those assets be able to be more mobile and usable for being able to get access to capital, or being able to trade them in order to derive liquidity in their portfolios.
Yeah, and I think the total railroad value as on chain right now is $25 billion. So a very long way to go. Think about traditional assets. What's possible there?
And Chris?
Yeah, as a participant more than issuer, it's difficult for me to guess what the TAM is going to be. It seems low. But I think we think in use cases. And I mean, even just looking at repo alone, like they count activity in trillions. Right? That's their unit account. And so I think if you expect something like repo to move on chain, which I think is a very natural workflow and trade to move there, it's almost like, it sounds strange, but almost like a vanilla trade workflow. You're talking about trillions and trillions of transactions. Broadridge is already conducting some of this with their DLR product, and they count in trillions. So I think we're only seeing the very, very tip of the iceberg right now, and things like the stablecoin bill passing and providing federal regulation for stablecoins, and the right organizations issuing these assets on chain appropriately. Like, it's just going to unlock such a significant amount of transactions in notional terms that we're all going to be very surprised by it.
Well, we started with the harsh reality today, and we ended with 16 trillion is too low by all 5 of you. So I think that's a great place to stop. But thank you all very much.